Interest rates aren't even close to where they should be in order to cram the inflation genie back into the bottle. That's the assessment of an analyst at one of the world's most famous banking institutions. Let's get into it. The Federal Reserve recently raised interest rates for the first time in more than 3 years, and the Fed is planning 10 more interest rate hikes by the end of 2023. Is it possible that that won't even move the needle on inflation? And if that is the case, what are the implications for retirement savers? The Federal Reserve is hot on the trail of the highest inflation rate in more than 40 years, 8.5%. The central bank says its mid-March 25 basis point rate bump will be followed by 6 more increases this year and another 4 in 2023. That's a lot of rate hikes. But current Fed plans reveal the sum of those increases will result in a federal funds rate that's just 2.75%. And according to analysts at global banking giant Credit Suisse, that's just not going to cut it, literally. While the Fed's projected rate hikes might appear restrictive, they are unlikely to sufficiently tame the current torrid pace of inflation. Not only is the rate too low today, but it will likely be too low even after the Fed completes its projected rate hikes. And where should interest rates be, in the opinion of Credit Suisse, to rein in inflation? 9.8%. That's not 9.8% by the end of next year. It's 9.8% right now. In drawing its conclusion, Credit Suisse referred to a monetary policy guideline known as the Taylor Rule. I'm not going to get into the details of the Taylor Rule's mechanics in this video, but I do want to get across at least the opinion of one respected global banking institution that interest rates will have to be pushed a lot higher in order to bring down inflation. Will it happen? We obviously can't know the future, but aggressive funds rate increases to chase down inflation are not without precedent. To reduce the high levels of inflation that characterized the 1970s and early 1980s, the Federal Reserve saw fit to raise the Fed funds rate to 20%. The good news is that this bold effort ultimately did send inflation packing. The bad news? 2 recessions followed, the second of which saw unemployment climb to nearly 11%. If Credit Suisse is right, then the Fed's reluctance to raise rates more than planned could mean persistently high inflation. But if the Fed does raise rates more significantly, we might be looking at an increased chance of recession. This much is clear. Uncertainty could be part of the economic landscape for the foreseeable future. To learn more about options during these uncertain times, schedule a free web conference with our economic team.
Hey guys, Joe Montana here with my man Devlin Steele. He and his team at Augusta Precious Metals are constantly putting out new information to keep you ahead of the game. Click subscribe now and hit the notification bell to stay up to date. You'll be glad you did.